Now, a lot of investors are looking towards rate rises, which are due soon. When do you expect this will be, and how are portfolios positioned for this?
Yeah, rate rises have been due soon for many, many years now, and it constantly amazes us that they never actually come through. The Fed is desperate to raise rates. They want to get away from emergency rates. They keep talking it up, but I think you need sufficient economic conditions to merit it. Unemployment has come down a lot. Inflation is too low, and growth is too low. There's some wage pressure, so it could probably merit a 25 basis point rise, maybe in December. And we would say, well, so what? Because mathematically, that's a tiny percentage increase, and it's been very well flagged, almost over flagged. So we're not particularly worried about that. What one could be worried about is the trend, how often rates went up, and where they peaked. And currently, given the economic outlook, we even don't think that's a major threat. So they may well come, but policy, in our opinion, would just be less loose. If they rose by 0.25%, rates would still be very low. What's much more important is economic confidence and the management of the economy by the central banks.
Now, the Greek crisis has moved today towards a resolution with the announcement of a deal. Is this a positive for fixed income assets?
It's a positive for risk assets. So equities and credit markets have rallied quite materially today, so that's encouraging. Sovereign bonds have sold off because there's less flight to quality in reverse. The Greek crisis is still a hell of a mess. They've got too much debt. There's endless tightroads that the Greek government has to deliver on. Their history of delivering privatization, receipt, structural reform, paying back debt is appalling, frankly. So longer term, we remain fairly sceptical on their ability to structurally reform the economy, to grow and to repay debt. The Europeans, especially French, were actually pretty supportive. The Germans were fairly unsupportive. So we're still pretty sceptical. But I think it's a kind of known unknown, if you like. So that some progress has been made, but longer term, we're pretty wary of investing in that part of the world. Having said that, we do think it's generally containable. And if anything, it's thrown up a few opportunities. Some cheap bonds have come out, and we've tucked a few away for the shareholders.
Okay, now some commentators point to the end of a 30-year bull run in bonds. How do you find value for investors?
Well, generally, I think the bull run is over. I think it's unlikely yields will go any lower than they got a while ago. Having said that, there's a bit of a shakeout recently on the back of Greece and on valuations as well. So in a credit shakeout, that throws up greater yields, which we can lock in for our investors. So we've done a little bit of that. Generally, we live in a kind of environment of low inflation, low growth, low defaults, with volatility spikes or liquidity vacuums. And on the back of that, given the herding that central bankers have pushed a lot of people into the same trade, occasionally an external event like Greece will push everyone in the boat the opposite side. That will throw up some valuation opportunities. And if you're patient and have some perspective, you can then lock in the greater yields in the companies you like, but you just have to wait for the bonds to come to you at the right price.
John Pattullo, thank you.
Thank you.